Hello, everybody. This is Daniel Young for Adaptive Perspective, where I am the owner and founder of Adaptive Perspective. I believe it's my purpose, my calling to help you identify your dreams and help you reach your financial freedom destination and maintain it so that you can pass your wealth on to the next generation. Uh, I'm continuing the closed-end fund reviews, uh, really to both help me and help you uh, targets target specific funds, but also see the information that is involved in this closed-end fund master. See the consolidation of data. See what we have. See how we're doing, and then how we filter all the data into these recommended funds. Uh, Reminders. It's an unedited video, so who knows what you'll hear in the background as I film these in my house. The glare is bad on this based on the angle. uh, Light in the kitchen and no light behind. I will be going over our strategy or our investment strategy of closed-end funds and how we filter all the data. The same disclaimers as normal. I am not a financial advisor. I am a financial strategist. The information contained in the video is provided on an as-is basis and does not represent personalized investment advice. Information is from sources believed reliable, but no guarantee or warranty is made as to its accuracy. I may be invested in some of the closed-end funds recommended or reviewed in the video, and the transparency is we own every fund colored in blue. I assume no liability for your use of the information contained herein, and encourage you to educate yourself on the market, to consult with a licensed professional, and to know your goals before investing in anything. And though I encourage you to talk with a licensed professional to get their advice, because quite honestly, I have to say that, I also encourage you to not be afraid to walk your own path. When we started investing, we did not consult with a licensed professional. I investigated tons of online market platforms and found Webull to be the most user friendly for somebody brand new. So we went with that. I don't speak like the herd. I don't walk with the herd. I walk in limited company, and sometimes I walk alone, and I'm okay with that. So let's look at some funds. So let me share my screen. So this is the closed-end fund master. It's got all these tabs at the bottom that I've reviewed in different videos. And today we're going to make another video. We're going to duplicate the last one. Doesn't like it because it's the same thing. I date these based on when I film them. So to get a blank slate, we go to the master, look at the targets. I update this on the weekends. So every fund with at least an asterisk, from one asterisk to three, gets updated every weekend. And I do a complete system update every month, generally at the end of the month going into the next month. So based on this month, here we are on the 21st. That means with the first being almost dead, like right after the middle of the week, I'll probably update it next weekend just so it's already done as we go into the next month. But of the current 438 funds, the average across all funds is still well above 8.5%. Some are better, some are worse. Just because it has a high yield doesn't mean it's a well-managed fund. And we own one of those. So we take our asterisks and we put it here, like that. We go to current. Current just means how many shares we own, so that as I decide what to buy and how much, I like to know what we already have. So we buy on discount. So that means everything on premium we can get rid of. Us personally, we're not going to buy anything new. I will leave a fund up here that we would buy if we weren't, but say if we were going to buy anything new, I'll leave it. Um, but we're not going to buy anything new. So let's see. Cuba is one of those funds that pays really well and is not well managed in my history. Hertzfeld, the guy who owns the fund, was hailed as one of the people who really helped kick off and start closed-end funds. They paid an amazing dividend. It's not funds in Cuba; it's funds that wrap around the Caribbean basin. Um, and with the up and down turmoil of everything, they sold their portfolio, and the portfolio is only cash. So that's not ideal. Um, it they pay a dividend, and yes, they pay an amazing dividend, but it's an automatic dividend reinvestment fund, meaning they pay you the dividend in cash. So let's say, so here I'll give you our example. So these are all the funds we own. They're just color coded different colors of blue just to really set the sections apart. So we own that. So currently we own that many shares, 109. So if I put 109 here, it automatically calculates the dividend every period, every quarter. So we get that dividend automatically every quarter. That dividend gets deposited into our Webull account. And then Cuba withdraws that amount. So they pay us the amount, but it's on an automatic dividend reinvestment program, meaning they pay us the amount, it drops into our account, and then they take the amount back and pay us back in shares. And overall, it gradually lowers the overall buy-in price. Me personally, I would rather like to invest those dividends where I would want instead of an automatic reinvestment into the company. So Cuba has nothing in their portfolio. It's just cash. So think about this. Unless it's in a high interest fund, which I have no idea where they park the money. So unless it's in a high interest 8% plus fund, inflation's at 4%, maybe 4.2%. So if like my standard account at Bank of America makes less than 0.5% a year, inflation is 4% a year. So we're losing at least 3.5% just on a basic savings account at Bank of America. Who knows where Hertzfeld has the money? But wherever that money is parked, unless it's in a high interest fund, it's not growing. It's just sitting there. So they're paying out dividends and then trading those for shares, but the money's not growing, or as far as I know, it's not growing. That's not a good investment model. So our goal on Cuba is to sell it as soon as it hits 20% gain, which it's gone up the past couple summers, and we're at a dividend yield so far where we're close to that overall 20% gain. It's close to the dividend payout. So we get about 3% per quarter. That should jump to 21, 22. If we can get that back close to 4, maybe at 4.2, it's an easy sell. We'll take that money and stick it somewhere better. So all of that, AGD bought out a fund that we owned called DDF and love DDF. Fairly consistent dividend, like it fluctuated a little bit, but they paid a hidden dividend at the end of the year. AOD, and make sure I didn't get rid of the fund that I would buy. AOD. Some people think it'll come back and do well. I'm not happy with how management has done. I love EOD's portfolio. We would buy more of it, honestly, right now. I'll leave it for right now, just to kind of sort it with the rest. Proof of point. Let's see. Yeah. Yep, I didn't. All right. So outside of discount, and I already know the funds that we're going to sort out and clear out. RQI is the only fund I would buy and that we don't already hold. So everything in blue we own. Everything in purple on that original list is recommended by somebody. And I don't just list anybody in that somebody. I mean, you can listen to the Motley Fool and they'll tell you to buy something. And the Motley Fool, from my experience, is called Motley Fool for a reason. I try to stay away from fools. Um, but yeah, all these funds in purple are listed by people that I read and I trust. Everything in green, which is olive green or kind of this amber slate green, depending on your computer screen. But everything in green is interesting, and that's why it gets updated every week. Um, but of this list, we own everything in blue, and this purple one we don't own. It comes well recommended by somebody I trust. I don't want NAV sorted. I want that sorted. And this is a slightly different dividend than what's posted because they paid a special dividend last year. So they pay 0.08 every month. But then they also paid this additional special dividend at the end of last year. So of these funds, GER made the cut last week, but it's currently selling for more than I would buy it for. And I know what we have and what we don't have. FEI, I like the company. They've not raised the dividend since we bought it. And the other three MLP oil and natural gas funds, GER, NML, actually four other funds, GER, NML, KMF, and KYN have all raised their dividends since the bottoming of the market in whatever that was, 2019, 2020. And FEI, to their credit, has had a consistent dividend payout throughout. Like the stock, everything plummeted, right? Their dividend payout stayed the same. But at the same time, it hasn't risen since then. KMF, word has it, will be bought out by the sister company, KYN. Your stocks in KMF will transfer into KYN, but not at a 1-to-1 ratio. So that doesn't really make me want to buy KMF, even though it's a great buy right now. HQL is healthcare, which is great for the long term, but it's not where we want to park money right now. It's also another dividend reinvestment program, which for that company, like I don't have to add to when it's another great, amazing buy and the market signals, hey, that's a great time to buy health and research and all that's then. But that's not right now. USA is a great buy right now. Same thing, it's another dividend reinvestment program. And for USA, I'm okay with. When funds are well managed, do I still want the dividend to figure out what to do? Would I rather the company let me figure out what to do with the dividend? Yes. But when the companies are well managed and we're in it for the long haul, like I have no plans to sell USA or HQL, then I'm not happy about it, but I'm at least willing to let them keep the dividend in that they pay us, they take it back and give us more shares. Um, but I'd still rather reinvest it myself. Uh, so these four are off for us. GER I love, I really do, I love, but of where it is right now, 1326 compared to where we've bought it, and I keep track of everything. 1326 will put it on the upper end of things. Uh, it's over our overall average. It would increase our overall average just based on the scale. And then, I mean, yeah, is it a DCA buy overall? Yeah, because it's still lower than 1368, but it's also higher than all of this stuff. So, I mean, it's like not that I want it to come back down, but I would consider it when it drops back down again. Um, let's see. So based on yield, I try to stay above GER, but my goal in buying has been to stay 10% above on yield. In USA, I would make an exception for a couple reasons. One, the discount is close to its 5-year historical net asset value. That's pretty much a 10% yield. Um, it's just a great time to buy the fund. For us, my warring factor has been split between three choices: USA, KYN, and IGR. Real estate has been hit hard. One, with the Fed's crazy rate hikes. Two, with say post pandemic, you look at uh, a lot of companies realize they don't need office retail space. You saw a lot of retail shift online. You saw a lot of offices and management companies shift to remote work environments. And rumor has it there's going to be a almost like a 20% part of the market default on office real estate or office real estate loans. So um, I forget which person this is attributed to, but it's the best time to buy is when there's blood in the water, or the best time to buy is when there's blood in the streets, even if it's your own blood. So IGR is an amazing dollar cost average buy for us. I mean, and we could buy a ton of it cheap. We could buy a ton of USA cheap. KYN is still cheap overall compared to our average. Let's see, they're pretty much 890. Oil is set to be in an amazing position the next 30 to 40 years. Um, Real estate is still great for the long run. And if the real estate market tanks that much as the projections, it's a great buy now. And yeah, it's all dollar cost average. Like we have no plans to sell it in the next year, 5 years even. I mean, I would hold IGR indefinitely. I have it listed as lifetime on our page. Um, so yeah, hold time, lifetime. But honestly, if it's going to continue to drop and there's a lot of uncertainty in all the say the office and the manufacturing real estate part of the market, then I don't want to buy it right now. So of what I know, of what I would target, all of this stuff I enjoy. It's just I only have so much money and you only have so much money. Um, it also depends. So do you want to get paid monthly or do you want to be paid quarterly? Do you want to be paid in specific quarters? USA has been a first quarter. No, sorry, USA is a mixed. It's 1369. KYN was a 13710, but as of this year, it might actually switch back to a true category one. EOD has been a category one, meaning it pays 14710. HFRO is doing a lot of stuff without its shareholders' input. A couple of years ago, they tried to shift the company outside of a closed-end fund, and all of it. Well, I don't know about all of us, but the majority of us said no. And now they want to do a buyback program, and they want to relabel the fund, and they're going to do that without the shareholders' approval, which just makes the shareholders, me included, not trust the company much. The buyback program sounds great because in theory it ought to raise the share price, but changing the company name and doing all that without even asking the shareholders just seems shady. NML is almost break even for us based on our price right now. FGB is all private equity or like business development company. It's exceedingly cheap in general and pays a really good dividend in an alternate quarterly fashion. HGLB, I like data management, satellite management, but also the real estate market. Oops, what did I delete? Wrong one. Technology is probably it's a great place to park your money, but not based on the other stuff that we're targeting. It's just not as much as I like it. It's not where we need to put our money right now. BRW is loans. FAX is a bond fund of it's the Asia China Rim. There's been so much news. A lot of people have forgotten about the China drama. China drama doesn't spook me in that regards, but a lot of new investors and a lot of people who don't understand the full story of things see the news go, oh no, China, and then they pull all their money out of funds that are invested in China. Same thing in Russia, same thing in Taiwan, same thing everywhere. So that price will continue to fluctuate. Their dividend has stayed consistent. I mean, they've paid the same dividend for forever. One of the guys I read and listen to is piling on in specific bond funds. And for the money we have, I like to buy things in sets of 50 because it makes the math easier. And even like for USA pays that automatic drip dividend or the dividend reinvestment program. So we own 58.59. I would honestly, like, I'd prefer to buy 42 shares. So it's an even, well, it's not an even 100, but I would, me personally, I like things when they're in sets of 50 because it's easier to calculate for me. And yeah. And this spreadsheet auto calculates everything just based on how I set it up. But at the same time, for me, I like sets of 50. Or if I buy 200, that's still sets of 50. RQI is real estate, and it's that same thing. They own a lot of good stuff, and they're positioned really well. Their buy-in price has come down. The discount has gone to almost double. It's a good time to buy. But I also know the money we have and the money we don't have. So for us, I don't want to add a fund right now. But for you, if you're looking to get in and wondering where to go, the difference between these videos and a lot of what you might else see or might see at other places, I'm going to recommend the funds that we would buy, and I'm not going to take your money. My job is to advise, and your job is to do your research and then figure out where to put your money. Like, I filter all of this information from trusted sources, but at the same time, I'm the one who's actually buying the stocks. And then for me, and between you and I would sell access to this document or this Google file with all of this other stuff. I've thought about it. Um, I've thought about membership. I've thought about pricing, but I have not created a membership or an access for it yet. So I do the videos to show value, to show what's here. But I mean, I would love to figure this out, to create a membership and access to these videos for that membership. Um, that's the money I would take. Like, here's my info. By all means, pay for access. But I'm not going to take your money to invest it in stocks for you. You need to do your investment research, and you can do it. You can buy stocks and you can manage your own fund. You can pay somebody to manage it for you, but you need to figure out your investment strategy. We have an investment broker. We have a financial advisor. We have very different investment strategies, and we're honestly trying to figure out the best way how to resolve that because though we like the guy, um, but we have very different investment strategies. And even though we like the guy, even though he's a nice guy, even though he does a good job, and even though overall you could argue that we're both moving toward that overall goal of helping us retire, um, our goal to live off dividends, our all of our self-managed portfolio is closed-end funds targeted towards living off the dividends. Are we at a place where we can live off the dividends? No, but it's a progress. It's a journey there. Little by little, the goal is there. His version is that speculative value of investing, but at the same time, that loses money. So if we'll say so, Microsoft, I don't think pays a dividend. I think Apple pays a 0.5% dividend. So if you buy whatever in Apple and inflation is at 4% and they pay a 0.5% dividend, you're losing 3.5% of your value every year to inflation. So 3.5 times 10 years, right? Like we can do the math on that, but if you can't do math in your head, that's okay. We'll do 5 years. 3.5 times five, you lose 17.5%. So if Apple goes, it's like, hey, buy Apple now, in 5 years it'll be worth 10% more. Well, that's great. But so fine. You're down 17%, right? So now you've still lost 7.5% of your money, even though the company is now worth more than it was when you bought it. So speculative investing off of no dividends or very limited dividends doesn't actually help you. And versus our portfolio, this is us. So shares owned is just what I keep track of. Total investment, annual dividend, general yield, right? How much money we've made in the last 2 years, maybe, and our overall return so far. And as these dividends go up, our overall return will increase. Some of these funds have rising dividends. As they continue to rise, that overall yield will go up. When we sell underperforming funds like AOD, HFRO, that smaller under 9 yield, that's close to 9, but under 9 yield will get a bump on our overall yield. So back to this. EOD I like, but they've decreased the dividend twice. So we're going to take that off. That's a decent go. If you like bonds, that's DSL and FACS. If you like preferreds, that's the NC sisters, NCV and CZ. But since I'm trying to streamline and really highlight the best of what I would pick, as much as I like these funds, and as much as almost any of them would be a great investment for us right now, this is where I would go. RQI, I leave it on because it's new and it's something we don't own. And it's not new, but it's something we don't own. And if we were going to add a fund, I would add that fund. And I know real estate right now is crazy, but if I was going to add a fund, I would add that fund. IGR is real estate, FGB is business development company, KYN is MLP or Master Limited Partnership for oil and natural gas. It's an energy transfer company or like a toll bridge company. And USA is primarily United States. I think it's like 99% United States based companies. It's pure stock. Um, yeah, and that's where I would go. And then on how this works or how I use this, that is not supposed to be there. It's supposed to be. So in, let's do this. Let's see. These two rows. So now I have two rows at the top that stay that way. So when I sort this on my end, I put our available funds here and a formula at the end. So we're going to take that minus the sum of these things, and it'll tell us how much we have left. So I like to buy things in sets of 50. So could I buy 50 of KYN? No. Could I buy 50 of USA? Yes, money left over. Oops. Could I buy things of, could I buy 50 of these? Yes. So six allows me to, right? 603 allows me to buy 50. That would mean those two would allow me to buy 50. These two would not allow me to buy 50 based on the current investment available. So putting in the numbers, it'll tell you what the dividend would be per period, but also what it would be for the year. And this is where the interesting things happen. So this pays a greater yield than USA, but USA, then that, I'm just checking my math, right? USA pays a greater annual yield because they pay a higher dividend, right? But IGR pays 0.06. So if we look at 0.06 based on a quarter payout, if it paid quarterly on the same scale, you'd be getting 18 cents a share. That's higher than 15 cents a share. So it makes sense that their annual dividend is higher than USA. But we're playing it for the long haul. So we're playing it for the long haul for the ongoing dividend. And we're also playing it based on that speculative value of we do hope it goes up. So whether it goes up or down, you get the dividend. So that in 5 years, depending your age, 5 years, 10 years, 20 years, whatever years, right? The longer you're in it, the longer you get the dividend. The price is going to go up and down. So your job is to dollar cost average. So you'll buy it when it's low and buy it when it's high and buy it somewhere in the middle so that your price overall levels out. And all the time you get the same dividend. And then if the company decides to cut a dividend, well, then you decide if you want to keep the company. You can also somewhat swing your dividends, meaning like I have some of these marked at 20%. You can, like this company bought out the company we owned. When this company goes to 20%, we'll sell it. There are some people who do that with the intention of making 20% a year. And I get like there's capital gains on that, but they're carrying forward their profits. So they're swinging from one investment to the next. So you can buy and hold, right? Some of these are long term, some of these are lifetime. The risk of that is this Fed meddling we've seen. So when the market crashes or the Fed overprints money intentionally, then prices widely vary. So you can keep a fund lifetime, right, to have it plummet. If they keep paying the same dividend and you're in it for the long haul, then you keep getting the dividend regardless of price. But the risk is having your money go down like that, the overall worth and value of your money go down while you write that out. So you got to find people you listen to and trust. You got to find people you trust and then listen to them. And if you have people that you trust going, hey, you should pull your money out of the market, like you don't have to. We're encouraging you to sell it and turn it into cash and just let it sit. There's value in hearing that, but the risk is the long-term hold. So if the market, like if you pull your money out and the market tanks, right? Well, you saved your money. But if you let it hang out for 6 months and or say, so if, excuse me, if inflation is 4% on the year and you let it hang out for 6 months and not do anything, then you're losing money just letting the money hang out. Like you pulled it out of the market to keep it safe so where it didn't plummet in value, but just parking it somewhere where it's not gaining money is still costing you money. So you have to look at the strategy overall. And you have to know what you want to do and what you want. So for us, where I would go, like I get that, like this is negative based on available funds. So what I would weigh out is USA is a great dollar cost average buy for us, as is IGR, as is FGB. But like I said, the real estate market right now, really iffy. Um, and as much as I like FGB and as much as I like who's in the fund, and as much as I like that yield, it the two that still are warring in my mind are this. KYN is set up great for the long haul, especially if their deal to buy their sister company goes through. And USA is set to go well for the long haul. So, so I mean, yeah, they're as of current pricing, they're both the DCA buys. USA would bring our overall average a lot further down, just based on our average price right now. But this is the ongoing battle in my mind. I know I can't buy 50 shares of it. So my mind is, do I keep adding funds and waiting for what until I can buy 50 shares? Or which would mean that I could buy, like if I could only buy 50 shares there, could I buy 100 shares there? But, so that's kind of the ongoing thing in my mind. So those are my top selections for the week, really for this Monday morning. So uh, like normal, if you like the content, consider subscribing to my channel. And then head over to Facebook and join my group there called Navigate Your Finances. The link will be in the description below. Just remember, you're the captain of your ship, and you have the power to change your life and your financial future. Many people will offer to help you, but only you can make the choice to do it. Make it happen. It's not going to happen on its own. If you want a different life, if you want a different financial destiny, it's not going to happen on its own, because if it would have already happened. Right? So if you want something different, you're going to have to do the work. So make it happen. Shock your world. And it's far easier than you think. And this is Daniel Young signing off. I will see you on the next one. Have a great week. Bye bye.